So we've just published our interim results for the 6 months to September. Our total accounting return over the period was 2.8% and a total profit of 14.5 million. So recognising the backdrop that we're operating in, we're pretty pleased with those. The portfolios performed well in terms of where we're invested. You know, our overweight position to industrial, warehouse, logistics, office, which is now about 80% of the portfolio, has really driven the performance over that period. So in terms of the numbers in a bit more detail, our NAV was up 0.9%. We had strong dividend cover of 107%, fully covered, and reinforcing the importance of income to our total return. And our gearing at the period end was just sub 25%, so a level we're quite comfortable with in the current climate. So the market as a whole is dealing with sort of self-inflicted Westminster chaos, but despite that, generally occupational demand is good and rents are rising. And not in a big way, but in a modest way, and that's encouraging. And I think, a number of things about commercial property. It's a real physical asset. People own it. There's a good income stream that supports the underlying value. And through proactive management, there's ways to enhance both income and value. And I think in this environment where interest rates are low and returns elsewhere are pretty meagre, commercial property still has a strong place within people's portfolios. Looking at the sectors within the overall property market, a couple of things to note. Firstly, that the headline numbers are being pulled down at the minute by what's happening in the retail sector and events, most recently with, Mothercare, Arcadia, etc., are not good for the retail sector, and that's an area which thankfully we have relatively low exposure to, but nevertheless, is a part of the market that is struggling. Personally, I don't think that's Brexit related per se. I think that's a wider change in shopping habits and or the value that retailers are attributing to that type of property. The converse of that is in the industrial sectors and to some extent the office sectors as well. And really in those markets, supply of floor space is reasonably limited. Occupational demand is pretty good. It's been better, but recognising the environment, it's still pretty good. And the combination of those two factors is really leading to modest but continually positive rental growth. And if we're seeing rental growth, we're seeing income growth. And if we're seeing income growth, we're seeing capital value growth. So from that perspective, the market is polarized. But I think if people look and drill down into the underlying fundamentals in the different sectors, they can see actually quite a positive story in quite a lot of the UK commercial market at the minute. Because Picton has a high exposure to the office and industrial sectors, over 80% currently, that's driven a good underlying performance at a property level. And we've outperformed, the MSCI Quarterly benchmark over this last 6-month reporting period. But also more pleasingly, that's building on a long-term track record of outperformance over 1, 3, 5, and 10 years. So the last 6 months have been very busy, a lot of activity in the portfolio, which again is perhaps counterintuitive with everything we're reading about. We've had quite a lot of leasing activity. We've also took the opportunity to surrender some space, but then give us the potential to re-let it at higher rents. More generally though, we're looking at refurbishing quite a number of our assets. As leases come to an end, we want to enhance the space before we release it, and that gives us the opportunity to capture higher rents. In terms of looking forwards, that there are 3 elements, I think, where we can grow the underlying income in the portfolio. The biggest is in terms of leasing vacant space. We have a current sort of dip in occupancy as lease events have happened. We've got about 5.8 million of rental income that could be achieved through leasing all the vacant space in the portfolio. And of our vacant space in the portfolio, nearly 80% of it currently is under refurbishment, ready for releasing. The two other areas where income can grow, one is where market rents are higher than current contracted rents. So when it comes to lease expiry or rent review, there's an element to capture that. And then finally, in terms of where we have occupiers in buildings that either currently are in a rent-free because it's the very start of their lease commitment, or actually where we've structured leases in the past that have stepped rental increases. And as those flow through, that certainly has a positive cash flow benefit. In terms of looking forwards, I think, more generally, we're in for a period of lower returns. The income component is going to be key. And for us, I think there's a number of factors. Firstly, we have a dividend yield at the minute of close to 4%, and that's a fully covered dividend, meaning we have spare monies to reinvest back into the portfolio. And I think the other aspect is that, looking at Picton top down, 80% in the office and industrial sectors, I think that's a good position to be in terms of where we're invested. We've got a highly diversified cash flow, which means there's limited occupier risk in any meaningful way. Our gearing, sub 25% is quite conservative, but I think that's right to be conservative at the minute. But we've got revolving credit facilities, to flex that if needed. And then I suppose the key and what we're focused on is what's going on in our own portfolio. And there's a lot of activity, a lot of projects, on the go. And as those start to come to fruition and we release those, that's where I think that there's the potential, notwithstanding a softer market generally, but to add value and income through those sort of active management projects being worked through.